Hey everyone, if you had to choose between these two options, which one would you pick? The first option is building steady, consistent profits month after month. The second option is making a huge amount of money very quickly, but with the risk of blowing your entire account just as fast. Most people would probably choose the first option, right? On social media, you constantly see traders showing off massive profits, making thousands or even tens of thousands of dollars in a single day, or doubling and tripling their accounts overnight. But that's usually just the highlight reel. What you don't see is that today's big win could easily turn into an even bigger loss tomorrow. The truth is, making money in trading isn't actually that hard. Even a complete beginner can win a few trades simply by luck. After all, the market only has two directions, up or down. If you randomly buy or sell, you already have close to a 50% chance of being right. But here's the problem. Luck might help you make money in the short term, but it will never keep you profitable in the long run. If you want trading to become a real profession and not just gambling, you need more than just a strategy. You need a system built on probability, risk management, and statistical edge. So how do traders actually become consistently profitable? Are successful traders simply better at predicting the future than everyone else? A lot of people believe trading is all about accurately predicting every move the market makes. But the reality is very different. No strategy can guarantee that price will move in your favor after you enter a trade. Markets are driven by probabilities, not certainty. That means your goal shouldn't be to win every trade. Your goal should be to build a system with positive expectancy over the long run. Let's use a simple example. Imagine a coin flip game. If the coin lands heads, you win $1.50. If it lands tails, you lose $1. Would you play? If you only had $1 to your name, probably not. One loss and you're done. But what if you had $100? Meaning you could play the game 100 times. Now things change. We know that over time, a coin flip will land heads about 50% of the time and tails about 50% of the time. So after 100 flips, you would likely win around 50 times $1.50 equals $75. And lose around 50 times $1 equals $50. That leaves you with a net profit of $25. This is exactly how probability works in trading. From this example, we can create a simple expectancy formula. Average profit per trade equals win rate times average win, loss rate times average loss. For example, win rate equals 50%. Risk to reward ratio equals 1 minute and 1.5 seconds. Then the expectancy becomes 50% times 1.5 r. 50% times 1 r equals plus 0.25 r per trade. That means even with only an average win rate, the system is still profitable over the long term. Of course, short-term results will always feel random. You may go through winning streaks or losing streaks, but once you take enough trades, your statistical edge starts to show up. Now let's say out of 100 trades, you only win 40 trades and lose 60. If every winning trade makes $1.50 and every losing trade loses $1, then 40 wins times $1.50 equals $60. 60 losses times $1 equals $60. You break even. That means with a 1 minute and 1.5 seconds risk to reward ratio, you only need a win rate above 40% to become profitable. In trading, we control this using stop loss and take profit levels. For example, you might risk only 1% of your account per trade while targeting 1.5% or 2% profit. This is what traders call the risk-to-reward ratio, or RR. The key is keeping your risk fixed on every trade. Maybe you only risk $10, $20, or 1% of your account each time. Then you target a reward that's larger than your risk. If you consistently follow that process over the long run, you can become profitable without needing an extremely high win rate. So when evaluating a trading strategy, the important thing isn't whether it's called price action, smart money, or indicator trading. What really matters is, does the strategy follow the core principle of the market? Buyers and sellers? Does it create a long-term statistical edge and consistent profitability? Are the entry and exit rules clear, objective, and measurable? Most traders fail because they spend all their time searching for the perfect strategy without ever testing it properly. A real trading system should be back-tested across hundreds or even thousands of trades to measure win rate, average risk-to-reward ratio, positive expectancy. Once you have a proven edge, the only thing left is proper risk management and the discipline to consistently follow your system. Trading is not about predicting the future. Trading is a game of probabilities, risk management, and discipline over the long run.